Have you ever wondered if it's possible to get the upside of the stock market without the gut-wrenching risk of losing everything? Well, that's pretty much the core promise of something called a fixed indexed annuity. Today, we're going to break down exactly how these things work, and we'll use a real-world example, the Ocean View Cap Lock, to do it. Let's dive in. So let's kick things off with the big question, the one that probably keeps a lot of people planning for retirement up at night. How in the world do you grow your savings with the market's potential, but at the same time not risk losing it all in a downturn? It's a classic financial tightrope walk, and for good reason. And that really leads us perfectly into our first section here, which I'm calling a retirement balancing act. This is all about that fundamental tug of war between the desire for growth and the absolute need for safety, especially the closer you get to retirement. I mean, think about it. On one side, you've got this need for growth. You want your money working for you, right? But on the other side, there's that very real, very understandable fear of losing what you've worked so hard to save. A huge market drop right before you retire? That's a nightmare scenario. And that is the exact dilemma that products like fixed indexed annuities were designed to address. Okay, so how do they actually do it? How do they pull off this balancing act? Let's pop the hood in Section 2 and see how your money can grow inside one of these things. First things first, let's start with the absolute basics. An annuity, at its heart, is just a contract you make with an insurance company. You give them a chunk of money, and in exchange, they promise to make payments back to you down the road. It's a tool for long-range goals, like, you guessed it, retirement. Now, let's add those other two words, fixed indexed. This is where it gets really interesting. An FIA links your potential interest earnings to a stock market index, like the S&P 500. But, and you got to listen closely here because this is the most important part, your money is never actually invested in the stock market. The index is just being used as a benchmark, a measuring stick, to calculate how much interest you could earn. This slide gives us the perfect way to visualize it, an escalator. Think about it. When the market index goes up, you ride the escalator up and you earn some interest. Simple enough. Now, there's a trade-off, which is called the cap. That's like a ceiling that limits just how high you can go in one go. But in exchange for that ceiling, if the market goes down, a floor kicks in. The escalator just stops. You don't go backwards. Your principal is protected from those market losses. You get zero for that year, but you don't lose. So that cap we just mentioned, it's a really important piece of the puzzle, and it's actually where this specific product, the cap lock, gets its name and its biggest selling point. Let's take a look at what they're calling the locked cap promise. You know, the product's own tagline from their materials says it all, doesn't it? Your cap, your term, locked. This idea of locking in some certainty is really the key thing they're trying to highlight here. So, just to be crystal clear, what is the cap rate? It's that ceiling we talked about. It's the maximum amount of interest you can possibly earn in a single year. So for example, if the S&P 500 goes up, say, 12%, but your cap rate is 8%, then you get credited 8% for the year. That's the most you can get. And here it is. This is the big difference. With a lot of standard FIAs, that cap rate can be changed by the insurance company every single year. So it might be 8% one year, but then they could drop it to 5% the next. That creates uncertainty. With this cap lock feature, though, the rate you get on day one is locked solid for your whole 5 or 7 year term. No annual resets, no surprises. So what does that really mean for you? Well, the big benefit here is predictability. You know exactly what your maximum growth potential is, year in and year out, for the entire term. It just makes planning a whole lot simpler. Okay, so the growth story is interesting. But what if you need your money? How accessible is it, really? Let's talk about the practical side of things, getting your money out. So let's start with the good news. Even though these are long-term products, you're not completely locked out. After your first year in the contract, you can take out up to 10% of your account's value each and every year without paying any penalties to the insurance company. That's a fair question, right? Life happens. Sometimes an emergency comes up and you might need to pull out a bigger chunk of cash during that initial term. Well, this is where something called surrender charges come into play. This table lays it all for us. If you take out more than that free 10% in any given year, a penalty applies. But, and this is important, it only applies to the amount above that 10% allowance. As you can see, the charge goes down every year. It starts at 9%, and then it stair-steps its way down to 0 by the time your term is up. Of course, with any financial product, you have got to read the fine print. It's super important. So for our last section, let's cover some of those key details you need to be aware of. All right, let's do a quick lightning round of key considerations. First, there's a $20,000 minimum to get started. Second, and this is a big one, annuities are insurance products. They are not bank deposits, so they are not FDIC insured. All the guarantees are backed by the financial strength of the insurance company that issues the contract. Also, there's something called a market value adjustment, or MVA, that could apply to early withdrawals. And finally, don't forget Uncle Sam. The IRS may have its own penalties if you take money out before you turn 59 and a half. So, what happens when you finally get to the end of your 5 or 7 year term? Well, it's pretty simple, actually. That whole surrender charge schedule we just looked at, it goes away completely. They're gone. At that point, you're back in the driver's seat. You've got options. You can take all your money and go home. You can decide to re-up for another term, maybe with new strategies, or you could choose to flip the switch and turn the whole thing into a guaranteed stream of income for retirement. And all of this really boils down to one final critical question that you have to ask yourself. In exchange for that 100% principal protection and the predictability of a locked cap rate, you are giving up the chance for those unlimited, massive gains you might see in a huge bull market. So the question is that trade-off, swapping unlimited potential for total predictability, worth it for you? That's really the core idea to think about. I hope this explainer helped you understand it a little better.